Alright, welcome back guys. In this video I will be explaining how to actually apply risk management. And before we do that, actually we're going to explain a bit more about how lot sizes work and basically how leverage works as well. So this will be a very important video, because if you don't know this and you can't apply risk management, then your trading career will never fly. So what we like to do is, I'm going to start immediately. So you get different types of lot sizes. You get your 0.01s. For instance, you get your 0.01s. You get your 0.10. You get your standard lots. So let's divide this into 3 categories. So I'll explain to you guys a bit more what I mean. So for instance, if you're in this category, this is the 0.01 lot size. This is what this actually means is that you are risking 1 cent per pip. So if the market moves from this price and it moves 10 pips, let's make it 10 pips till this point, then you would either, if the trade is in a profitable position, you would either make 10 cents for 10 pips. Does that make sense? So you would basically make 10 cents per pip. This is in this category. There is a lot of lot size. You get 0.02, 0.03, 0.04, etc. until 0.10. So I'm just going to use this as an example for you guys to actually understand. So if your entry point was here and the market moves up 10 pips, then basically what you will have made is 10 cents in dollar. It doesn't matter where your account is. So in rands, in South African rands, it will be like 10 cents on dollar is now 13 rand something. So I can do the math for you guys, but I think you guys understand what I'm trying to say is, so for instance, if your position moves like 100 pips, then you know 10 pips is 10 cents. Now you know 20 pips is 20 cents basically, if the market moves in your direction. So this is very important to actually understand, because this will actually help you apply your risk management to your trades. So if you go up 100, like for instance 50 pips, if you have a trade and it's 50 pips, you'll make 50 cents. Does it make sense? So it actually determines, for each pip it moves, it gives you 1 cent. So for instance, if you're in this, let me just erase this. So for instance, if you're in this category, let me just show you guys. If you're in this category, then if your entry point is here, so now we're moving at 0.10 lot size. So now this is your entry point. Price moves up 10 pips. Now for every pip, listen properly, for every pip, this will be 10 cents. Listen properly. So here's 1 cent. You get the 1 cent lots, then you get the 10 cent lots. So this means if this thing moves 10 pips, then you can basically, for every 1 pip, you make 10 cents. So if you times 10 by 10, you know you will make basically $1 per, like for $1 per 10 pips. So what this actually means is, like now you must have your risk factors in mind. Bear in mind, if your stop loss is 100 pips, then you know basically I'm risking $10, and maybe your take profit is somewhere around here. You are risking you're risking 1 to 2 risk to reward. Then for instance, if your take profit is around here, this area, then you know exactly, like, all right, I have maybe a 50 pip take profit, and you know you have a 10 pip stop loss. So now that's a good risk to reward. Now you know if your take profit gets hit, then you must know now for it. So remember, for every 10 pips you get 10 cents. You get $1. So now you must know, if my take profit is hit, I will basically make $5. You guys are still with me? I think you guys still understand. So now I risk my 10 pips. Now I know I risk $1 for $5. So now we're going to move on to this category. So it's relatively easy if you understand it, and it will make your life so much easier with the risk reward, your risk management actually. So you have to understand that if your lot sizes are not accordingly, then you will blow your account. Like for instance, we in this category, we basically now a one standard lot. So now it's relatively easy. If your entry point is here, we're running at $1 lot, standard lot basically. So this was 10 cents, this was 1 cent. Now we're running for one standard. So it's relatively easy. If your take profit is at 100 pips and your stop loss is at 30 pips or whatever. So now if my trade moves in my direction, and this is 100 pips, you know that it is $1 per pip. So now you must know, guys, this is very important to understand, because I see a lot of people, a lot of beginners over risk their accounts. Sorry for that. You must remember, brothers and sisters, if you got $100 in your account and you trade with one standard lot, this means, maybe for instance your stop loss is about 30 pips. This means you're risking $30 in your stop loss, and that is basically bad, because that is basically you risking 30% of your account, which is very bad. Because if you risk 30% of your account, if you lose that trade, you will basically remaining have $70 in your account. But if you win that account, it is high risk. We call this high risk, high reward, and that's not the way you should trade. We want low risk, high rewards, or low risk, low rewards. That's the way we trade. So if you win this trade, you will make $100, because it's 100 pips, and it's one standard lot, so it's $1 per pip. So basically, then you would make your $100 if you win this trade, but you will actually lose your $30 if you lose this trade, if your stop loss is 30 pips. So this is very important to actually understand, guys, because if you don't understand this, you won't know how actually to apply risk management properly, because this is actually relatively easy to understand. If you understand this, you know what you're risking. So what we like to do is, and I think this is a lot of traders does this, we actually try to risk 1 to 2% of our accounts. So we're not gonna risk the whole 20, 30, 40% of our account. We're actually just gonna risk. So my thing is this: if I enter here, for instance, right, I have $100 account. I enter here $100, sorry, account. I enter. This is my entry point. You forget about these two if you have $100 account, guys. Please, this is very important. You stick with your 0.01s. For $100 account, I would suggest you use 0.01. A lot of people differ, but I do 0.05. That's this is over risking, still over risking, but I mean this is the money. I think this is the highest you can actually go. It depends on which type of trader you are. Like if you're scalping, that's your high, basically your high lot size that you can use. The reason for that is you will blow your account instantly if you use high lot sizes. So high lot sizes basically says to, if you use 10 cents, you know it's 10 cents per lot. So as I already explained to you guys, that it's a lot of pips. So if your stop loss even at 40 pips, it's a lot of money you can lose. So what we try to do is, if you have $100 account, let me just check now. If you have $100 account, then you must basically risk 1 to 2%. 1 to 2%. So this is very important. So 1% of $100 is what? $1. Yeah, 1% is $1 basically. So you're risking $1, $1 to $2 per entry. Per entry, guys, this is important. Per entry. So it's per trade. It's not you're risking $1 to $2, but you have 10, 15 trades running. Then you know most for every trade you have, maybe you have 1, 2, 3, 4 trades running. Then you know if you're risking 2%, maybe $2, this will be $2, $2, $2, $2. So at the end you're risking $8. You understand what I mean? So this is 8% you are risking of your account, and that is not what we're looking at. So this is very important to actually understand. I think it's relatively easy if you understand how the lot size. That's why I'm starting with lot size, because if you understand how lot sizes work, you understand actually what you are risking. So it will make your life easier. So let me just erase this. I think it's very easy. It's relatively easy to understand and relatively simple. So our risk management is basically what we try to do in the forex market. Is we try to get we try to risk 1 to 2 or more. So meaning, what I mean by that is, if my entry point is here, I want to risk 1 for 2 or 3 or 4 or 5 or 6. That's, you understand? So my entry point is here. So this is 1 to 2. This is 1 to 3. This is 1 to 4. I'm just making an example. This is 1 to 6. So I'm risking this 1. So it will be like my stop loss will be here. Take profits here in this areas. So yes, what we try to use is always 1 to 2. That's your minimum. Then you get 1 to 3. So your take profit must be 3 times what you risk. Does that make sense? So you won't go for, even if you go like that, if your entry point is here, you risk 1 to 1